U.S. natural gas futures closed the week with a cautious rebound, recovering from Thursday's pullback as forecasts for extreme heat and steady electricity demand kept bullish sentiment alive. Still, strong production, a mildly bearish EIA storage report, and a rising rig count are capping enthusiasm. LNG feed gas flows remain solid, averaging around 15.2 billion cubic feet per day, slightly lower week-on-week but still historically elevated. In Europe, storage levels stand at 63%, well below the 5-year average of 72%. While this gap has not triggered urgency among overseas buyers yet, it could bolster U.S. exports in the coming months. Weather models remain central to the bullish narrative. Fresh forecasts project extreme heat across much of the U.S. through late July, with temperatures surging into the 90s and 100s in key demand regions. Weather analysts describe the 6 to 15-day outlook as decisively hotter, while the atmospheric G2 model emphasized persistent heat in the Midwest, South Central, and Southwest. This heat is driving up air conditioning use and boosting gas-fired power burns. Reflecting that, U.S. electricity generation rose 1.1% year-on-year for the week ending July 12 and is up 2.4% over the past 52 weeks, according to the Edison Electric Institute. Such firm utility demand continues to provide a floor for gas prices. Meanwhile, U.S. dry gas production climbed to 108.3 billion cubic feet per day on Friday, up 5.3% from a year ago, while domestic demand remains flat near 78 billion cubic feet per day. This growing imbalance is reinforced by increasing drilling activity. Baker Hughes reported 9 more gas rigs this week, lifting the total to 117, the highest since early 2023, signaling that producers are gearing up for even stronger output into late summer. If the supply-demand imbalance continues to widen, it could set the stage for a sharp price correction heading into late August or September. Without a sustained boost in demand, whether from prolonged heat or stronger LNG exports, growing production and high storage levels may overwhelm the market, forcing prices lower as fundamentals reassert themselves. The short-term outlook remains cautiously bullish, driven by persistent heat and firm power sector demand. However, rising production and elevated storage levels are capping gains. For prices to push materially higher, traders will need to see hotter than expected weather and a meaningful pickup in LNG demand. Otherwise, supply-side pressures could limit further upside. Key resistance remains around $3.75, while support holds near $3.50. A sustained break above $3.75 could open the door to a run toward the $4 mark, but a drop below $3.50 may shift momentum back in favor of the bears. Please like, subscribe, and comment to support the channel. See you in the next one.